So we are going to look at a question on share-based payment transaction. So we have types of share-based payment transactions. So starting with equity share-based payment transactions, we have cash. Then there's that third one, which is a choice. So for the equity share-based payment transactions, let's look at a question of April 2024. So April 2024. So there was a question which was tested in that sitting. That is question 4b. Question 4b. So from this topic of IFRS 2. So this is a topic of IFRS 2, share-based payment transactions. So the equity share-based payment transactions. So how do you account for that? Equity share-based payment transactions according to IFRS 2. So remember that I can mention a few things that when accounting for this, there's that basic rule that the fair value, which is given as per the grant date, is the one which will do what? Prevail throughout the vesting period. So that when carrying out your accounting for this, that fair value, which will be given as per the grant date, is the one which will do what? Prevail throughout the vesting period. So on this case, we will not be having a fluctuation in terms of fair value. So we go with the fair value as per the grant date. And the share-based payment transactions, remember now equity, it should be done what? It should be recognized as an expense throughout that period. But the main rule is that that fair value as per the grant date is the one to apply throughout the vesting period. So let's go and look at April 2024 question 4b. Question 4b. So they were saying that on 1st April 2021, each of the 7 directors of Hill Limited received 16,000 share options as an award. Hill Limited prepares its accounts to 31st March each year. The conditions attached to the award of the share options was that the directors must remain in employment for 3 years. So that is, remember, that is a vesting condition, which is a service, that the condition attached to the award of the share options was that the director must remain in employment for the 3 years. So that is a vesting condition, which is a service. So the fair value of each share option as at the grant date was shillings 100. So you can see already you are given that fair value as per the grant date. So the fair value of each share option as at 31st March 2022, 2023, 2024 was 105, 110, 115 respectively. But now, will these prices apply anywhere? Because they are saying that the fair value of each option as at 31st March 2022, 2023, 2024 was 105, 110, 115 respectively. So they will not apply anywhere because I said under equity, how do we know that this is an equity share-based payment transactions first? Because Hill Limited received 16,000 share options, not cash, share options as an award. We continue. We continue. As at 31st March 2022, it was estimated that 2 directors could leave before the end of 3 years. Due to an economic upturn, the estimate of the number of the directors who were going to leave as at 31st March 2023 was revised to 1 director. The expense for the year as regards the share options had not been included in the statement of profit or loss for the current year, and no director had left by 31st March 2023. However, 1 director eventually left the company by 31st March 2024. Required demonstrate the accounting treatment of the above share option transactions in the financial statements of Hill Limited for the year ended 31st March 2022, 2023, 2024. So they need us to demonstrate the accounting treatment of the above share option. Which type of share option first is this? I have said it's equity. It's equity based on the awards which he limited received 16,000 share options. So you can mention that this type of equity settled share-based this is an equity settled share-based payment scheme. So already you know that is a mark if you mention that this is an equity settled share-based payment transaction. Then now you go ahead to demonstrate on the accounting part of it. So the first thing we do is to do what? Is to calculate. So calculate, that is a calculation of expense. So the calculation of expense and the cumulative expenses. And cumulative expenses. So you calculation of expenses and the cumulative expenses. So the first column will be the year, the period. So we say year ended. So our financial years with calculations done there. Then now remember I have said we are computing what expenses for the year and the cumulative expenses. So there's another year column for cumulative expenses. So the cumulative expenses. And at the end there, we talk about expenses for the year. Expenses for the year. So our first year was ending when? Our first year was ending as at which period? Guys? Our first year was, so remember that on 1st April 2021, each of the 7 directors of Hill Limited received 16,000 share options. So from April 2021 to 2024, April 2021 to March 2024. So we have March 2024. So there's a first year here ending March 2022. Even they mentioned somewhere in between that question, there's a paragraph there whereby they say that the fair value of each share options as at 31st March 2022, 2023, 2024 was 105, 110, 115 respectively. So, but remember it was from April 2021. That is when the 7 directors benefited by receiving 16,000 share options. So for the April, that is 31st, for 1st April 2021, this financial year ends when? From April 2021 to 31st March?
31st March 2022.
2022. So we have that one. Then we have the next year, 31st March 2023. 31st March
2024.
So 2022, 2023,
2024.
2024. So we have those 3 periods. So our financial year, the first one, and year ended 31st March 2022. 31st March 2022. So let's do the relevant calculations here. Let us do the relevant calculations here. So there's those directors who are to leave and the one who are going to remain. That is what you need to check. They mentioned about some directors leaving and some doing what? Remaining. So in the first year, how many remained? There's this paragraph. They said as at 31st March 2022, it was estimated that 2 directors could leave before the end of 3 years. before the end of 3 years due to an economic upturn. Due to an economic upturn, the estimate of the number of directors who are going to leave as at 31st March 2023 was revised to 1 director. Was revised to 1 director. Then the expense for the expense for the year as regard the share options had not been included in the statement of profit or loss for the current year, and no director had left, by 31st March 2023. However, 1 director eventually left the company by 31st March 2024. So how many directors were there in 2022 by March 2022? I'm asking you guys, how many directors?
7.
7.
So 7 directors were there from the initial period, but now there's somewhere they're mentioning that it was estimated that 2 directors could leave before the end of 3 years, before the end of the 3 years. So they did an estimate of 2 directors, but this one was revised. This one was revised in 2023 to 1 director. To 1 director leaving. So meaning that by 2022, we have, see, they did an estimate. So you have to consider that estimate. So they were there initially 7. So they are estimating that 2 could leave. So that estimate is important. You have to put it into consideration, meaning that we have 5 directors remaining in the year 2022 due to the estimate which was made. Then in 2023, remember this one was revised to 1. So meaning that I say 7 minus 1, I have 6. And they said eventually, in the year 2024, 1 director did what? 1 director left. So even there we have 6. So that is what I will do here. So I will say 5 times their awards. They received how many awards? According to the question, they received 16,000 awards.
16,000.
The price, I said the fair value as per the grant date will prevail. The fair value as per grant date. The fair value as per the grant date is the one which will prevail throughout the vesting period. Throughout this period. So, and remember in that question you were given 100. The fair value as per the grant date is 100. So 10 shillings 100. This is the first year out of the vesting period of how many years? So we have 3. All right, so 31st March 2023. So 31st March 2023, we have 6 times 16,000 10 shillings 100. And this is the second period out of the vesting period of 3 years. And now we go to the last one, 31st March 2024. 31st March 2024. So we have the 6 terms, 16,000 10 shillings 100 times the 3rd year out of the vesting period of 3 years. So you can see the fair value as per the grant date is prevailing throughout the fair value as per the grant date is prevailing throughout the vesting period. So under equity share-based payment transactions, there's no fluctuation in terms of prices. So the price, that is the fair value, as per the grant date, prevails throughout the vesting period. So you can do your computations and give me the answers. from my end, today I don't have a calculator with me, so I expect you guys to give me the answers for this one. Let's do the first one first, then I will be able to tell you how to do the expense for the year. So the first one is?
John.
Yes?
80 million.
You are saying? So you can say, you can decide to put it even in millions, eh? So you can reduce it, eh? Shillings in million, shillings in million.
A question.
Mm-hmm.
There's that part that says for the expense for the year as regards the share options had not been included, and no director had left by 31st March 2023.
Mm-hmm.
I don't get that part.
So remember that what is affecting my first year and the second year is the estimate which was made. Even if eventually no director has been left by 31st March 2023, but there were some estimates which were made in the year 2022 and 2023. So the estimates must be put into consideration when doing this. So remember that in the year, by the end of the year 2022, they estimated that 2 directors could leave. That in the 3-year period, it was estimated that 2 directors could leave before the end of the 3 years. That is before the end of the 3 years, due to an economic upturn. So the estimate of the number, so that estimate which was made was revised. So what I'm putting into consideration for me to deduct the 2 and 1, these are estimates. Eh? But actually, where we have 1 direct leaving is in the 3rd year. This is the actual value. So these are estimates. You have to put estimates into consideration. Are we together?
Okay. Yeah.
So what do you have here? You don't have calculators, and we are doing
For second year, we have a 6,400 million.
So you are saying
The second year is the 6,400 million.
6,400,000.
6,400,000, yes.
So that is 6.4. I said we do in the first year. The first year is important because for expense for the year.
2.6 first year.
2.7.
First one is 2.7.
In 2 decimal places.
6.7.
6.7. Eh? So even here we have 2.67. So meaning that for you to get this expense for the in the second year, deduct 2.67 from 6.4. Well, this is the cumulative. So this is inside here. So deduct
3.73.
3.73. 3.73. Then the cumulative for the 3rd year.
9.6.
9.6. Eh? So 9.6. So if you deduct 6.4 from 9.6, deduct 6.4 from here, it will be
3.2.
3.2. So that is 3.2. 3.2. So they needed us to do what? To demonstrate on. So let's go back to the question again. So demonstrate the accounting treatment of the above share options in the financial statements. So in the financial statements. So we have to do an extract of the financial statement. So after doing the calculations, So we have the statement of profit or loss and the statement of financial position. So how will you recognize this calculation in your statement? So statement of a profit or loss. So statement of a profit or loss. Statement of profit or loss, the extract. Statement of profit or loss. So remember that we have 3 years. So we start from 2022, 2023, 2024. So remember that we have cumulative expenses and expenses for the year. This one goes to the P&L, to P&L, so which is the statement of profit or loss. And this one to statement of a financial position. So to the statement of financial position. So this one is 2022, 2023, 2024. You are aware that our financial year was ending. So year ended. So it's March, 31st March. So what do I have to recognize here? So this is an expense for the year. So the staff. So remember that these people who are being compensated, they did what? So they were directors. They were directors. Each of the 7 directors, they are receiving 16,000 share options as award. So that is like a staff cost to the entity. So the staff cost to the entity based on share-based, based on equity share-based payment plan. So I come here and mention staff cost. So 2.67, 3.73, and a 3.2. So to P&L. So what I mentioned here is this and this and this. So that is an extract. That is an extract. Then statement of financial position. Statement of financial position extract. So statement of asset. The period we have is asset. As at 31st March. So we have 2022, 2023, 2024. So what would I recognize there? I have said it's the cumulative expenses. So the cumulative expenses as a liability or as an asset?
Iko sawa sasa.
Avoid a lot of noise kindly, the unnecessary one. So the cumulative expenses will be recognized as? It's an equity.
Liability.
It's an equity. Equity share option. So it's an equity share or option. So the equity share option. You can say share-based scheme. So that is a 2.67, 6.4, and the last one is 9.6. 9.6. So this question was having how many marks? 8 marks, So this question was having 8 marks. How did they mark this? So 8 marks, they marked this one, Here. You see this? This is what was marked. So that is what was marked. Then I say once you mention that this is an equity share-based payment transactions, also we have a mark here. So out of 1, 2, 3, 4, 5, 6, 7, they needed any what? Any 4 correct. Out of these 1, 2, 3, 4, 5, 6, 7. Any 4, then they multiply by 2. You get your 8 marks. So that is equity. So the main thing you need to know is that about the fair value. So the fair value as per the grant date. You see this fair value as per the grant date is the one which is doing what? Prevailing throughout the vesting period. Is the one which is prevailing throughout the vesting period. So we can look at another one, or you are okay with the equity share-based payment transaction. Are you okay with it?